Welcome. Happy Thursday, everyone. We hope you're all having a good week and are happy that you can join us. This is the second to last workshop session that we have scheduled for our profitability workshop, and we appreciate you all having been here. So today we're going to talk about personal income targeting. Okay, we glitched there for a minute. Today we're going to talk about personal income targeting, and I'm going to share my screen. I can remember how to do that. And I'm also going to, Sam, put you on as a panelist. That way you don't have to raise your hand or anything if you want to say something. And we can chat. So let's make sure that it actually, yep. Oh, good. Did do that. Okay. Hi, Sam. How are you?
Good morning. I'm doing well. How are you doing?
Good.
We've got a little Sesame Street in the background, so I'm going to keep it muted here. So it's nice to see you too.
Yeah. Nice to see you too. All right. There it is. Thank you. Appreciate it. I've lost it. I have too many tabs up. Today is the deadline for the workers' comp true ups, which is great. And generally speaking, all good. But also a PSA, if you have workers' comp, you have to do a true up today. So if that was not on your radar, log into ID and go to workers' comp and submit that based off of your actual payroll. And then they will.
Thank you for that reminder. It's on my to-do list, but I didn't have a date next to it. So this is very helpful. Thank you.
Yeah, it's due today.
Yes, so that's why my computer looks like something's exploded on it, but I will just pull up our one tab here. All right, can you see my screen?
I can.
Okay, good.
Did you have any questions? Were you able to watch the last couple of videos? Did you have any questions on that before we move forward?
I appreciate you asking. I haven't had a chance to catch up. So I'm sure I will, and I will try to include those in my August one-on-one.
Perfect.
Thank you.
No problem. All right. So just to recap a little bit, we are going to be sending out the sheets that we talked about today in tomorrow's email. We have gone over the assessment. We've gone over a lot of information. Let's see if I can keep it all straight. We've gone over the assessment. We've gone over specifically different ways to finagle the percentages. I'm actually going to go back down to the worksheet we're talking about today. We did talk about pricing. We talked about sales. We did then talk about pain points or profit points to do with the expense side of it. So obviously changing anything to do with sales or pricing will adjust the percentages if the expenses don't change. If the expenses change, then the percentages won't perhaps change. And we talked about cost of goods sold. Then we talked about different expense categories like marketing, like rent, like cost of goods sold, like supplies and materials, labor. We talked about staffing specifically. So we've gone over a lot of those different things. Last week was when we talked about marketing and return on investment for that. So just some different ways that you can utilize different marketing tactics without a lot of spending. There's still equity that you're putting into it because you're either putting money or you're putting time behind it. So we talked specifically and had Olivia talk about some marketing that can be done where the equity is your time instead of the money. But if it's going to be money, that tends to be a sinkhole of an account. So what it looks like to track that. So today, because this is our second to last, I want to make sure that if you have any questions, you jump in and ask them so that we can cover those, because next week we're going to be talking about what it looks like to maintain this system. So the nice thing is if you choose to stay in this group, you do have the one-on-one time. And so every month or every couple of months, we can maintain together and we can talk about that during the one-on-one time. So especially every quarter, it's nice to tweak the system, look at it and see if anything needs adjusted. So we're going to cover that in depth next week. So this week, what we have to talk about is personal income targeting and how that ties back into the business, how that ties into the percentages. We're going to do some reverse engineering, and I may even bring up our spreadsheets again, and our sample P&L. And then we will discuss, that's what we have on the agenda. But if there's anything that we want to talk about, or there's anything that you want to talk about that's been on the brain, this would be the week to do it. So if there is nothing so far.
Not at the moment. No, I mean, all the things. So I was in the workshop when we talked kind of like going through the whole process. And we didn't get into the details of staffing and that kind of thing, but I do look forward to looking at that, checking that out, because we have been really focusing on our labor. 68's been closed for a month. It's going to be closed for a month, and it's shut down our business quite a lot, which means staffing has been a big part of it. And we're actually trying to take this opportunity to slim down our staffing because it's obvious that we need it. And then when it picks back up, hopefully not need to bring it back up, like, oh, here's a great reason for us to cut some hours out, and then we'll just keep it that way. And people will just adjust to it. So, yeah, I'm really looking forward to that. But for this session, then I would just like to carry on with what you have going on.
Okay. No, that sounds great. I don't remember which week it was. And you said that it's jogged my memory. We talked about one of the books that we'd been discussing. It was The 6 Types of Working Genius. So I don't remember when that was, week 8, week 9. It's in there. I think you weren't able to join us that week, Sam. And Carrie specifically, we did like a Q&A together of what that looks like because we've been implementing those 6 types of working genius into our business and just experimenting with what it looks like to take the assessment as a team and then see if people's jobs can be tweaked so that they can work a little bit more in their geniuses and work a little bit out of their frustrations. I think what we noticed as a team is the frustrations are dead on. The other 4 types that the book talks about, which this is a very high level, so there are 6 types of working genius. Everybody, they say in the book, has 2, where if you got to work in those 2, you would never feel like you had to go to work a day in your life. 2, where you're competent, but you don't love it. You're kind of ambivalent. And 2, that you're really frustrated. If you have to do those things for an extended period, then you would get burnt out. The frustrations were spot on for everybody. The other 4, people felt like they could be interchangeable a little bit. But we were doing a Q&A specifically about Carrie's time in the restaurant and how that affected her and her team, because obviously she hadn't read 6 Types of Working Genius. It hadn't been written at that point, I don't think. And still, she has people that come, I mean, a lot of people that have worked for her at the restaurant years ago.
20 years ago.
I mean, yeah, 20 years ago, that want to work with her now, even though it's in a professional services capacity, who may not even be accountants, just because they enjoyed working with Carrie that much. So that was pretty great and is a unique situation. So without even knowing that, you somehow moved people into roles where they felt like they could thrive, even though it is a service-based industry and they were high schoolers or college students, which it feels really difficult. And most of the time, I feel like I hear people that struggle with that. So that was a really good session. So sorry, we went on a tangent, but it would be a good one if you are thinking about staffing to go back and watch that one. Yeah.
I'll definitely do that. I appreciate it. Yeah. I mean, this is labor for us is like such a huge deal. And it seems when I've been looking at our numbers, it's grown. And when I look back, I don't see the relative growth of our sales. And I'm like, okay, why are we pay, and really the answer is we've been hiring people to do the jobs that we were doing because we're trying to get ourselves out of these positions. But then we came to the realization we just can't do that. I mean, we simply can't because we won't pay the bills. And so we've had to actually, just last week, we had to actually ask somebody who was part-time that we had to tell them that we no longer can keep them employed because we have to do their job now.
Yeah.
Because we were doing it before. But so this kind of strategies we're trying to just get those to fit into the hours that are already allotted to people instead of hiring somebody else to do them and adding on to those hours. So again, I don't want to digress from what you have going on today, but that's a very sore spot for me right now. Yeah, it's tough. It's tough because the full-timers, it's really hard to take away their money. Right. You can't just cut hours on people that are living off of this our job entirely. So It's a conundrum that I've never been in before.
Yeah.
No, don't feel like, we built in time for this. We'll still talk
about
targeting, so we can talk about this and we'll still hit that.
Well, and you're not the only one having that problem. All businesses are having that problem right now.
Yeah. Well, these changes also with the legal changes to wages, we had to shift people from tipped positions to hourly positions.
Yeah.
And that's a big jump.
Yeah.
Because you can't just necessarily also take, when we moved somebody, we had this busser dishwasher that was a tipped position, but it turns out they were doing probably 60% or more dishwashing, which is not generally, I don't know how they decide what the tip is, what regards to, what it is that really distinguishes a tipped action versus a non-tipped action, since it's a whole system that has to run. But, that was I can't just pay the minimum wage because they were making $13 an hour with tips when we worked it out on, the spreadsheet. So to just go down to minimum wage, I had to bring the wage way up. And that's and I was still paying above the tipped minimum wage, which is I was paying $7.10, but from $7.10 to, $11.50 or $13 or something like that, that's a huge difference. So, these non-discrete jumps that come, whether they're from a increase in the labor because of law or because of they shut down the highway that runs to our business for a month from the town that's closest to us. It's these challenges, and it's like shows you how fragile the business can be, especially in these early stages where we don't have a big savings, Right. So it is making us get creative though. And I'm trying to keep that spirit going that this whole workshop and this whole mentality is about. It's like, okay, well, how are we going to get creative to still make this work? And, it's exhausting, but it's good. It's good. So I'll definitely revamp or revisit the staffing one. So all these things are for us. It's kind of like all these things. None of these things are taking me by big surprise, but it's good to put them all into this comprehensive system and see. Just how to chip away at it. Right. We made a change with our disposables recently. Like, we can't do these premium boxes to everybody. We're going to do these those ones that still fit our brand, but are half the price, and these little things are all hopefully just going to add up and get us where we need to be,
They will.
So
it's awesome. Well, while you're thinking about it, we'll add one more piece of it and reverse engineer the personal income targeting. So if you guys are putting yourselves back into some of the working of the business, this may be a good one.
Yeah. And I'll say this is actually something that was on our minds last night. I'm glad we're talking about this right now. And the first thing that we're to do, and then I'll stop talking, so I want to hear what you have to say. Is that we need to, even though we're not paying ourselves and we don't clock in or out to get paid, we're going to start clocking in and out for every position that we do to track what it is that we're doing and how long we're doing it, to start getting a sense of what even if we were just, paying ourselves the wage we pay anybody else, how much money we would be paying somebody else so that we can factor that in and know when we can actually hire somebody because we have the revenue to, right now we're not paying ourselves. We're not going to pay ourselves for a while, but we'd love to get ourselves out of the kitchen and out of the dishwashing tank, So we're going to start clocking in and out when we do it. So maybe that's part of this too. I'm not sure.
Yeah, and that it's a different session we did, but it's also to do with staffing. We spent a little bit of time on staffing. Carrie went through a spreadsheet that we sent out. I'll make sure we sent that out. That was helpful specifically on that. So if you track how many hours you have, if you have, 6 part-time employees, or just track how many employees you have in general, how many hours each of them are spending, whether it's part-time or full-time hours. That exercise kind of takes you through and shows you who's working most efficiently and who's working least efficiently, and whether or not it could be beneficial to hire part-time for certain jobs or full-time, or how many staff members you need for the amount of revenue that you bring in. So if it's less staff members for the amount of revenue that you bring in, then how do the current people need to be more efficient? And it sort of reveals all of that.
Yeah, I think
you
I'm
did a
pretty
better job.
sure. She sent that spreadsheet and how to do it. Yeah.
Yeah, so that would be
Another thing that you could do is if you did an org chart
oh yeah.
for your company, and then filled in every position. And I'm talking as far as marketing, and you have a section for the marketing, who does the social media, who does the website, who does, all the things, Facebook, and then who does like your whole restaurant stuff. Like if you list everything out, and I can give you an example of like how we did ours, and then you color code who, like you have a color, Emma has a color, and then all your employees, and then you color code who does what, and you can see visually, oh my gosh, this person is doing all of this for the amount of hours, whereas this person's only doing this much. Maybe they can handle some of this.
Right.
And it'll also like when you're calculating your hours for the stuff that you're doing that you would like to give away, you can see how much they can take off of your plate.
That's a great idea. I mean, that's a part that's really hard for me. And that's maybe where we maybe need to get a more of a systematic approach to the tasks that are done, because the kitchen is as you know, kind of such a free flowing thing where maybe you sell out of fried chicken one day, so that needs to be breaded the next day, and that's a different person who's working the next day than this one person. So it's not like Jason does fried chicken every week, but early on, we had this one staff person, and she was awesome, but she was very, very slow, and she would make 8 donuts, and it would take her 2 hours, and they were $2.50 each, and they were $1 each to make. And I'm like, man, even if we sell all of these, we only lose $16. So, that's a very hard thing to nail down in the kitchen, because hopefully you have multiple things going on, right? I mean, you can get the sausage gravy going, and that can be cooking down, and you're stirring it occasionally while you're doing something else. So I would love to see that version of it, because then, I mean, it's not like it'd be impossible to get a sense of things, though, and especially when you're talking about things like, all right, well, who's sitting down and paying the bills, and who's sitting down and doing the accounting, and who's sitting down and running the Facebook page and all that stuff. That's all stuff that just gets integrated into our lives,
Yeah, definitely get the one-on-one stuff sessions that we do. I mean, we can fit all of that kind of stuff in, and I can give you how we did it.
Okay, thank you so much.
Yeah. All right. So we'll ask some questions and we'll segue into personal income targeting. All right. So personal income targeting is beneficial when we're discussing owner's pay, or even if you are going to, because we do some of the similar situation where there are some day-to-day tasks we don't want to do, that we would prefer to be out of some of the day-to-day of our business. And so even the owner's income targeting is what tasks do we do and what could we pay someone else to do them? And then how could we still take money as owners of the business while farming out some of those tasks?
Yeah, and some of those tasks may be just outsourcing it. It doesn't have to be you hire an employee, because sometimes it might be cheaper to outsource it than to take on an employee with, the taxes and all the crap that you have to deal with and turnover. Sometimes it's just easier to outsource it. Like we outsourced marketing because it wasn't our jam. We outsourced it for a while until we were able to hire somebody full time. So that was something that we didn't want to do. We weren't good at it. We were wasting our time trying to figure it out when we could have been getting more clients. And so it was more cost effective for us to outsource that.
Right.
Stuff like that. Yeah.
Yes. So the first question is, how much money did you take from your business in the past 12 months to support your personal lifestyle? This includes wages from payroll. So if you're breaking them down, or if you have a payroll provider that's breaking them down, it's gross wages. Any draws that you take or any distributions from the business, any personal expenses that you have paid out through the business, any cell phone bills, vehicle costs, maintenance for the vehicle, health insurance, etc.
Income tax.
Yeah, this is my
personal income tax. Yeah.
Yeah, this is my PSA that don't run your personal expenses through the business. We included in this because business owners do that, but PSA, don't do it. Keep the personal and business separate if you can. Take draws and then move the money into your personal account and then pay your personal bills out of that. It's just cleaner. Eventually, if you grow to the size, if you're a sole proprietor or an LLC right now and you're not being taxed as an S Corp, because it doesn't make sense to do that until you grow a little bit, eventually when you are an S Corp and you do grow, you will not be able to run personal expenses through the business. So if you build the habits now, you won't have to change anything once you grow.
Okay. That was the one piece of legal advice that stuck out to me. And it was like the one message that the lawyer had when we were consulting. Said, well, just don't mix up your personal and business money and you're fine. Yeah. Pretty much, you know.
Super important. Yes. If there's one piece of advice that anyone follows, it's going to be that. All right. Were you able to meet all of your personal financial goals with this income? This is beyond survival. So were you able to contribute to your retirement accounts or your IRA, 401k? Were you able to put money into different retirement strategies, say investing, or contribute to different plans that you have for your kids, college savings, or charities, anything. It can be, there's so many different things. This is all where the personal comes in. And, we hear a lot of times that, personal and business don't mix, but for us as entrepreneurs, they do mix. The business feeds our personal life. So it is very important. And we do have to take into consideration how much we need to make to live. And the business has to be able to support that. Otherwise, we just have a really expensive hobby that we will constantly be stressed about and will affect our personal life and our relationships because it cannot maintain that. So, all right, that's net profitability too. So if you are profitable, but you're reinvesting into the business is sustaining itself and it is profitable and it is not, just losing money. So I say that with a grain of salt. There's some different situations. If you're reinvesting all the money because you're trying to reach a new level of growth in the business and a new strategy, then it is not necessarily that you have just an expensive hobby as opposed to a business. It's just good to keep in mind that the business needs to take care of you as the owner as well. So
do you mind if I just jump in and ask one quick question on that? So we're not paying ourselves, or if you wanted to know that number, it'd be a negative number as of this first year of what we put in more than we've taken out. But so that's not awesome, but it's also, I'm not sure when, and maybe this is a better discussion for a personal session, please feel free to say so. But, for a restaurant, at what point, if we're just breaking even, at what point is that like, all right, you should really be making money by now? Because I hear all these different figures. People say, you're not going to make any money the first 3 years. And I'm like, well, what does that mean exactly? Does that mean like, people expect to lose money for 3 years, or they start breaking even, or I'm not making good money? And if that's a person, if that's a one-on-one, that's one thing, but or in general, is there like a business kind of a standard period of time that you should be able to live off your business or something like that?
Yeah, I mean, it's different for every restaurant depending on, investors and all the things that they have. But I would say for a small restaurant like you and like I had, and after 2 years, if I wasn't going to make money, I wasn't going to keep sinking money into it.
Yeah. Yeah. We haven't really sunk much money into it. And in fact, it's more like I've had to pop a money out in occasionally, pop it back out. They're kind of that's kind of hopefully the idea, but
As
2 years would be the number you'd say. Okay. I think we're feeling good about that. I think it's going in the right direction, but
I mean, that was for me. It might be something different for you. Like if you're breaking even and you're like, oh, I can see, profitability in the future. We're headed in the right direction. Last year I lost $10,000. This year I'm breaking even. Next year, maybe I'll make $10,000. As long as you see a growth, that's different. But if I am losing, $50,000 a year, I'm not gonna. It just depends. It's all relative.
sure. Yeah. I mean, in my head, I think, well, there's going to come a point where I pay off this loan, and then all of this money I'm paying into the loan, if I'm not silly about it, will go into my pocket.
Right.
As long as I don't find a way to spend it on something else.
Yeah.
And there are a few things like that, like building up the equipment and everything. But okay, I appreciate it. You answered my question there. Thank you.
Yeah.
Okay. Yes, that is a good question. I'm glad that you asked that because there are a lot of different factors about whether or not it's the right time or it's even reasonable to expect that you can pay yourself from your business. And that's not a condemnation on the business. So if you're just starting out and it is in an industry like a restaurant where you are putting money in and then you're growing and you give yourself a deadline, it is reasonable to expect that it will take a few years before you start to take money back out.
Yeah.
If you have a business that has existed for a few years and you're trying to reach a new level of the business and you're trying to grow and you're being strategic about it. So you've intentionally hired more people in your workforce, but then you have an intentional plan for growth and marketing, but you've invested in the business. So you didn't take money as an owner's distribution that year. That doesn't necessarily mean that the business is not doing well. It just means that you were profitable and reinvested the money back into the business. But if you need the money to support your personal life and the business cannot do that, and none of those other situations are going on, then it's time to question it. And while those things are even happening, it's good to determine what personal financial goals you have, and what personal financial needs you have, because we've worked this method with businesses who are just starting out. We've worked this method with businesses who are really small and who are really large. And with the businesses that are smaller, they wanted to start. So we've done it both ways with people because this is your business and the percentage is not you. We're just the support team and helping make the assessment and the percentages work. But it does not work. What we've seen not work is you just set the percentages, like I need 15% for tax, and I've been spending, 70% on operating expenses. And so that leaves me with, and there's the other categories, but basically that I'm only going to put 5% to owner's pay. But if you are only bringing in 50,000 in net profit a year, or that wasn't even realistic. Let's say the business grosses 100,000, that's more realistic of what we're talking about. And then you have all of these expenses, but that is your main source of income. Then we have to reverse engineer what the owner's pay needs to be. And then we have to chop OpEx because that is that business owner's main source of income. So sometimes you have to make OpEx or you have to make owner's comp account one of the priorities, depending if there are things that a spouse doesn't work or it's just you and there is no partner at home and this business is your sole source of income. And even if you're just starting out, even if it's been a few years and it's smaller and you haven't grown, or this is the first year, it doesn't matter. You have to decide what personal bills need to get paid by the business. And then we have to use that and build into the percentage and create the owner's comp percentage based off of whatever historical data we have. And then something else just has to be chopped.
Yeah. Yeah. So if you're in your example, if you need $50,000 to live, that's what you need to live, and this is your only source of income, and you only bring home, or the gross is only 100,000, then 50% needs to go to owner's comp. And
Right. Yeah. I mean, in our situation, because I'm working a full-time job,
yes, you're in a better
we
situation.
were like, okay, we can keep our borrowing lower because we're not going to be living off of essentially the loan for the amount of time it takes to make money from this business, which we knew wasn't going to be from day one, due to like our inexperience and the nature of the business and all those things. But yeah, I definitely have a financial goal to to not scrape by like we are, and sometimes it is a little, and I know that, and this is not a criticism at all, but sometimes for me, when we'll be like, well, let's say you're paying yourself 60,000 a year, and I'm like, oh man, that'd be awesome. Like, all right, what are you paying yourself? Like, take that number. I'm like, okay, negative $4,000 or something. It's a little bit concerning to me, where I'm like, are we okay? The thing for me is we have the sales, we have customers, right? And that's good.
Yeah.
So if we have that, we just have to make adjustments around that. If you don't have sales, then you're not okay. Right. But we have sales, so we just need to make adjustments around that. That's why I'm talking with you two as much as I can about it. And then, but yeah, I guess I just was bringing this up because it's like, I don't want to wait 10 years till I pay off my loan to make any money off of this. And I don't think I'll need to. So just trying to get a sense of just, keep the panic attacks down,
Yeah.
And it's not realistic, sometimes to say like, yeah, this is going to be our salary and it's going to be 60,000 or 50,000. That's why sometimes this is better to just be super practical of like, okay, my personal bank account, here's the bills that come out. These are going to come out somewhere. I have to pay for them. I either have a way outside of the business to pay for them, or the business has to pay for them. And if it's the business, then that is set in stone. Then the owner's pay just is what it is, and something else has got to be revamped.
Yeah, and I think that goes back to your earlier question: is how long should we do this and not be profitable? And that's why I said it's relative, because if you're in a position where you don't really need the money and you're at least paying off the loan, and maybe you make enough of the next year, a little bit and a little bit, then you're fine maybe to keep going, if that's up to you, as long as you don't burn out. But for somebody else, when we start working with them and this is their only source of income and they need half of that income just to live, then this conversation, maybe this isn't what you need to be doing. And we have told people that, because they weren't making enough money for their lifestyle. So something had to give, and there was no way, unless they weren't willing to work for it. So we were like, you probably should not be in business, because you can't afford to have your business.
Yeah. Yeah. And it probably also depends too on whether you're doing it if there are reasons other than financial reasons, which, I mean, running a business is, to make money, but it's not solely to make money for a lot of people, and we do have feelings about what we're doing as being important to us. Right. But I still think that once I actually get to the point where I'm going to sit down and get these, because I don't have the bank accounts going and everything, I'm still going to put, even if it's $20 a month, I'm still going to create those accounts, and I'm putting money in, because then I can adjust them, just to see a little bit of money that's going into, you got to see something going into that profit, because QuickBooks is saying that we're making a profit, and I know what we're spending it on, and we're spending it on getting things that we need.
Yeah.
We're spending it on getting the things that we need, and maybe making a mistake by hiring somebody that we didn't need, and then correcting that, so correcting our mistakes. But eventually, and hopefully sooner than later, we're going to get to the point where we have the stuff we need, we have the people we need, and we have the systems, and then we'll keep making those adjustments. So, okay, well, thank you very much. I'm feeling a little bit better about it, and I'll let you carry on. So thank you.
No problem. Yeah, and you're right. I mean, purpose is just as important. I mean, and honestly, that's what keeps you going when you are discouraged and feeling burnt out, is why you're doing this. That's not for the money. All right, let us now discuss how we reverse engineer your business income. All right, so this is a throwback from the assessment earlier on in the workshop. So we discussed the target dollar amount and then the target percentage amount in the real revenue. So the total gross sales minus your cost of goods sold, the supplies, materials, any packaging, labor, that's direct. After that, that's the real revenue. So if you're looking at your QuickBooks online, it's your gross profit. That's the real revenue number. And then we were talking about what your target profit is, your target owner's compensation, your target tax, and your target operating expenses. We did have numbers in there. So we generally put, a target percentage for tax at 15%. But this is where this worksheet specifically is really great, because a target allocation percentage of tax at 15% is not always accurate, especially in the first few years of the business. The target dollar amount is often way more helpful, because you can see, did I even owe any tax last year? Is there something that's going to change this year that would cause me to owe tax? Probably halfway, 3/4 of the way through the year, you can start to tell whether or not you're going to owe tax like you would for the following year. So we always recommend that you have something going into that allocation percentage, because you want to be building up the habit, and also you don't want to get blindsided because it's September and now you're just now realizing, oh yeah, I am making money this year, so I probably will owe some tax. I haven't been putting any into a tax account. But there's a huge difference between putting 5% or even 2% and 15%, because it's just not realistic. You might owe it might be realistic to say that you owed $3,000 on a federal return for your business in past years, and year over year, that's what you've seen. And that's combination of personal and business, because the business return flows through to the personal. And that's what you guys owed, was a couple $1,000s. So then that's the target dollar amount, say it's $3,000 for tax. That is not going to be probably 15% of the total income. So we're reverse engineering that percentage to be more realistic, rather than just, here's the target percentage, this is what people do, because that's not helpful. In the same vein, owner's comp, exactly the same situation for owner's comp. Enter your total from.
Well, this, we want to do the target.
Yeah. Sorry. So we're doing the target. All right. So I'm trying to walk you through it,
Well,
but
the tax target would be, like you said, exactly. Go from last year and what you think you'll owe this year, you put that dollar amount in. So if you owed 3,000 last year and you think you're going to owe about the same, I would stick with that number.
Yes. So there's two different ways you can do this. This set of instructions is, okay, if you've gone through with historical data, we're going to go through two different ways you can do it. I don't think either one is wrong. I actually think that you probably would want to do both. If you have time and the inclination to crunch some numbers, I do both. So if you've already gone through, or you are planning to go through, because I know there's a few people that have been watching back that have been saving this and are going to go through all of the information at one time. If you are pulling all of your reports from QuickBooks and you are going to create your assessment, and you're going to see all of your historical dollar amounts and percentages for real revenue after COGS, the profit that you've been able to take or loss, either one, the owner's compensation you've been able to take, the tax, and the amount that you've been spending in operating expenses, both dollar and percentage, then the next natural step is to look at a target. This is going to, you can either take a target percentage and turn it into a dollar amount, or take the dollar amount and turn it into a percentage. So it's easier, back at week 2 or week 3 to see all of those numbers and be talking about them. This is my real, I spend 67.5% of my real revenue in operating expenses. And so my target is to get it down to 60. And then you would put your target allocation here as a percentage. And my percentage is going to be taxed. And then you're adding those up to 100 based off of the historical accurate information. You can do that. And if you do that, and if you have done it, then what you're doing is then you're turning those into dollar amounts based off of your target real revenue. So your target real revenue, you're multiplying by the percentages, and that will get you your target dollar amount. That is helpful, but a little bit vague. So what I would recommend that you do is reverse engineer by choosing the dollar amounts that you need for everything. And I will say that, we've utilized profit first method for years now, and we still have a spreadsheet outside of everything. I mean, our QuickBooks, we work on that and maintain it and use those reports, and they are very important. And we use those reports to identify our percentages. But then at the same time, we are constantly doing this, reverse engineering the actual dollar amount. So we'll have a spreadsheet that literally has every single reoccurring expense, and it gets updated every couple of months just to keep us accountable, even though we probably will pull all of our expenses in QuickBooks too, because we don't want to be surprised. And if we're trying to grow, and it depends on what stage of business we're in, but if we're trying to grow and we're making strategic decisions, then that holds us accountable to actually make the decision. Because if we're like, okay, yeah, we're going to swap this out and this is going to lead to this, and here's what we're going to do with this. And so we're going to be intentional about our money. I mean, we're a small business too, just like all of you. If we decide that and then we don't do anything with it, we can't actually make any changes because they all depend on us moving our dollars around. So to reverse engineer, I talked about tax. I think that is a really good place to start, quite possibly one of the easiest places to start, because it's just one, it's one item. Your CPA or you with TurboTax know how much you've spent in taxes over the last couple of years. You have been paying taxes personally, even if you're new to the business. And even if the business has lost money, you still have either paid money or received money back from the government on your personal tax return. So you know and can make a decision of what your target tax dollar amount should be. And owner's comp, profit, and tax are all to the benefit of the owner. Operating expense includes payroll, the employer portion of the payroll taxes, if you have payroll. So when I'm talking about tax, I'm talking about the income tax that you owe on your business. So include your personal taxes on there because you're building this up so that you can pay it. It's a benefit that the business is providing to you as the owner to be able to pay the taxes. But really, I mean, let's just say that the real revenue is, let's just say that your real revenue after your cost of goods sold is what? 50% or $50,000. And then you have all of your expenses after that. If you had your tax percentage set at 15% of your real revenue, that's $7,500 that you were expecting to pay in tax. That may or may not be realistic. I mean, hopefully we're also really diving into some tax saving strategies here and some growth strategies for the business and personally. And it's generally not realistic that you owe 15% straight up of real revenue.
Yeah, so you would just change your percentage like in that first page, like when it says the target is 15%, we would just change it to, whatever it is, 3%.
Right.
And then that would come down here to the dollar amount.
Right. So let's say, we're doing target dollar amounts here. So the target dollar amount for tax is $3,000. That means that if we're saying the real revenue, we expect to be 50 based off of strategies that you have for the business, historical information, and all of it. That puts your tax percentage at 6, which is more realistic. If you're really just worried about it, you can always make them higher. Owner's comp is the same. So like I mentioned before, what we generally advise people to do right off the bat, I know we asked questions before, and when you send them, you'll see, that we're asking things like, what would you want your business to do? Like, what does it mean to be able to thrive and the business pays for these things? And that's great, but we need to start at what's practical and what you need first and make sure that the business covers those and that the percentage when you are starting this is correct for the things that you need. That way you don't there's not a hole where you're going to overdraw your personal account because we didn't allocate enough to your owner's draw percentage, then you're frustrated, then you're moving money from different bank accounts and the system doesn't seem sustainable. So when we're talking about owner's comp, I think the best thing to do is to get into your personal bank accounts, go through 3 months worth of personal expenses, specifically pull out the reoccurring monthly expenses. It's like building a personal budget. And see, so you have different categories for personal, just like you have different categories for your business. So you have your reoccurring expenses, let's say rent or mortgage, utility bills, any subscriptions that you have, auto insurance or health insurance, any loan payments that you have personally, anything set up like that. Is there anything that you can think of that I'm not thinking of that would fall into that category? Then you have the things that, yes. Then you have the things that are coming out that you are just swiping your debit card for. So those are the things like food and fuel. You have to have a certain percentage.
Yeah.
Right. You have to think, okay, if I was going to just swipe my debit card because I need these things, how much do I need to spend on food and fuel? And we are totally getting into personal budgeting here. And I will actually be the first to say, I think about this in categories just like profit first, because I utilize this system personally. So I have, I think, 6 personal bank accounts, and I budget all of my items into reoccurring expenses. And it includes all of my home items and other reoccurring subscription costs and different things like that. And it's one category that I'm thinking of, and it gets its own percentage, and it's actually its own bank account. Then I have one for lifestyle that includes different things, that we would spend on clothing or pets, or, all of the things that we consider to be part of the lifestyle that we have, or our home or maintenance. And then we have one that's just, this is food and fuel, because those are really big and tend to be budget eaters for everyone. So when you're talking about how much money do you need for owner's comp, splitting it up like that and being a little bit more
Intentional about it.
right, thinking about it in terms of boxes maybe, or like categories, is helpful, because, okay, you have your reoccurrings and they are going to come out no matter what happens. And then you have your, we need these to live. We need food to live. We need fuel for our vehicle. And so we're going to swipe our debit card. And here is approximately what we spend on those things, which is why it's nice to do 3 months worth of personal expenses and then take the average of what you spend on those. Then you have your category that's like, it is lifestyle. It's how much do we generally spend on hair and clothes and pets and different things around our house and maintaining our vehicles and maintaining our home and going to Target, right? And gifts and all of the things that make up our life. It can even be broken down into other things, and it does still matter. And you do still want to build it into your owner's comp. So there's layers of how owner's comp can be built. And there's layers of how owner's comp could be built and how much the business contributes to it. So the business could be, you could break out all of the things that are going to be coming out of your bank account personally as reoccurring expenses, total them up monthly, and be like, okay, the business needs to cover at least my reoccurring expenses. So if the business was going to cover at least my reoccurring expenses, they are $17.50 a month, and the business percentage would be this. And this is my owner's comp percentage for now. And that's realistic for me, and I'm okay with that. Or it could be they need to cover my reoccurring expenses and my food and fuel. And I've given myself this much. And so if this is going to be my, that moves me up to $3,000 a month, which gives me a little over $1,000 for food and fuel and other things that we swipe our debit card for and on my reoccurring expenses. And that makes my owner's comp percentage this. And then if my owner's comp percentage is this, personally, I know that my budget is set at this. And so if I'm exceeding my budget personally, I'll throw off my business owner's comp percentage. So you can do, or you can, answer these questions like we have them written out and go dream big. The business, I want it to support my lifestyle too. I want to support my needs.
And your personal goals. So like if you, like I have one for vacation, because I want to take a nice vacation a year. So I have a separate account that part of our money goes into that. Charity, like our giving is important. So I have a whole separate account for our giving. And so, my percentage of our income as soon as we get paid goes into that. And so if we want the business, like she said, to support all of those too, like even your personal goals, hopefully you get to that point to where you can constantly, like, it depends on what you want. Like if you're just starting out and you're just trying to get by, maybe that's a big goal, just trying not to go into debt. And that's great. Then you do that. And then, we constantly are looking at your goals, because this is not just set it and that's it.
Right.
Especially if you're just starting out, you have to continually look at it. And then we recommend like meeting at least like quarterly, like we go through it again. Let's go through your percentages again. Let's see where you are and, see if you're still on track. And then maybe you're way over, and then you can set another goal. And you just taking them in bite size, because there's no way, if you want to set a huge goal, you're not going to get there next week, next month, next quarter, and maybe not even next year. It just depends. It might be you have to chop off a chunk. Okay, so maybe it's $500 a month or $100 a month, whatever the difference is. It's easier if you can just do it in bite-sized chunks.
Yes.
I have a quick question about, like, let's say your tax allocation, allocation percentage was kind of off. Like, let's say you originally thought it was going to be a certain amount. So you said 15, but it turns out it's really only 8.
Right.
My question is, what's the most strategic way to repurpose those percentages? Because it's like, there's one part of me that says, oh, I could like slip those into some other place so I'm meeting my target goals. But I don't know if that sounds like that's the right thing to do, because then you're like kind of planning stagnation, where maybe what you need to do is try to move some of that into owner's comp or into profitability, so that you're moving toward goals. Is that right?
Yes, that's right. Or paying off debt.
Or paying off debt. That's a biggie right there. Yeah, that's kind of where my head is. It's like, how do I get this stuff out of debt? And then, yeah. Okay, thank you.
Yes, I would say that's really good advice, because eventually you want to get to the place where you have, maybe a 15% tax allocation. So you don't want to move it back into OPEX. You want to still keep that mindset that OPEX should be lean, and you're implementing strategies to either increase pricing or increase sales and lower expenses. But it doesn't mean you can't be creative if you've over allocated to tax and put it either to debt or start putting it towards like another goal.
Yeah.
If that's one of the goals, that's a good one. But if equipment's one of the goals, you can start funneling it into there.
Yeah, or a savings. Like it's very important to have like a 3 to 6 month savings account that you just feel if something like a road closure is going to significantly hurt your business for a month, you're okay, because you have savings to deal with that. Or we have another COVID situation, whatever it is, you're going to weather the storm.
Right. Or equipment breaks.
Yeah. And you need a huge equipment's not cheap. So
right.
Yeah.
That could be, a savings account for it could be one for equipment. That is the goal, is we're going to buy this next piece of equipment. And eventually it'd be great to have one that's for equipment maintenance. That's the savings account for that. But it could just be, that's the rainy day fund for equipment. And if we don't have to use it, that's amazing. We're going to buy a new one when we get here. And if we have to, because this one breaks, then we have it.
Yeah, we even do that like personally. If we, I have an account for a new car, because I know I'm going to need a new car in the next 10 years. And so I'm putting money away a little bit, because so that at least, I have some money there to buy a car. So it's kind of that mentality too. Same with your business. Just like you said, even if it's $20, it'll add up, over a couple years' time.
That's true. Yep. And it's
and just have that category.
Yeah.
I mean, for me, just to like get that set up, and that category is there, and it's the system is there. It's like, I don't think it helps very much mentally to have no bank account for where your money's going to go. I'm not even going to start the bank account. No, I'll get the bank account going. I'll put a few bucks in there. Watch it. And I like what you said about vacation. It's like, gosh, I'd love to put one for travel. Just open a bank account for travel and be like, all right, there's nothing in it, but there will be.
Yeah,
exactly.
Even if it's $5.
Yeah, exactly.
Because you do get like addicted to it, because I'll look at my personal finance and I'll be like, think I can put a little bit more. I know I'm only supposed to put this much, but
Yeah.
you
Yeah.
know,
I used to do that bartending when I literally I had different books and I would
yeah,
just not look at my tips. I just pull money out and stuff it in there and be like, it doesn't exist. You know what I mean? And it's the same thing. You're
yeah.
talking about the same thing, and I'd open up my book and be like, where am I going to go to now? You know?
Mhm.
Yeah.
Yeah, I mean, it makes it a little bit more fun.
Hmm.
I mean, it makes finances fun a little bit.
Yeah.
And also, a lot of finances is habits.
Hmm.
I mean, the money has to be there at some point, but the habits are the most important. So if you're doing it now with a little, you will do it when you have a lot.
True. Yeah, this whole mindset is just rethinking your habits. And it is kind of like, even people, when we talk to them about their retirement, I was like, just especially kids, that's their first, I say kids, but adults, that's their first job. Like, just start taking it. You're not even going to miss, don't even get used to it. Just do it. You won't even miss it. Yes.
So I have a question, well, a thought that I want to follow up in probably more in the one-on-one, but and it has to do with return on investment because there are certain things in the beginning of our business when for example, we had this idea of having a soft serve machine that's a countertop soft serve machine. We've talked to you about this, Carrie, because you have a lot of experience with this. And it's like the unit we were looking at is like it was 15,000 then, it's probably $20,000 now, 3 years later. And I could see there's also a possible trap for if you make more money. Here, hold on, sorry. If you make more money, you invest money into things that maybe you won't even make money back. Because I feel like if we had $20,000, what would I need to do with that? Well, I'd want to put that in savings or put that toward debt. But eventually, when do I feel like I would make money off of this off serve machine.
Yeah. Well,
But
that's a good thing because I mean, to your point too, eventually you're going to get to a point where your debt's paid off, you're making money, and you have to minimize tax. And so maybe it is a piece of equipment that you need to buy that's going to minimize tax and provide additional revenue like an ice cream machine.
so
And
that's when you do that strategically. Maybe
yes,
not when I don't have savings and I'm paying off debt, but wait till I'm at that place because that's going to have a double benefit.
yeah, yeah.
Okay,
And it could
cool.
be
Yeah.
that's paid off and you still have a lot of profit that you're going to have to pay tax on. You know what I mean? Your sales could be really great, but you still have that initial startup loan that,
Yeah.
maybe it's such a low interest rate, it's not tax benefit wise for you to pay that off because you're not going to get a tax benefit to pay that off. You might want, it's something we would need to talk about for sure because you might want to keep that loan for the write-off and buy equipment and make more revenue. It just depends on what your goal is and how much tax that, we want to minimize.
Right.
Yeah, I guess, return on investment in general is a concept that's very elusive to me because, there are certain things that we do that seem to like build our brand, but, if they're not making money, then they seem like they're a bad idea.
Yeah.
Like, even if they are building, I mean, we got to build our brand another way if we're not making money off of the things that we're doing. Or at least, yeah, I don't know. So return on investment is just, I guess, when we talk about that, and I think about buying a piece of equipment, and this is you may have already talked about this in a session I wasn't able to make, but I guess in general, I'm looking to understand return on investment more and how that can be calculated, where I can determine whether or not something's worth it.
Yes.
Whether it's hiring somebody to bake pies in the morning,
Right.
how, like, I don't know, like, the formula to put together to determine whether or not it's going to make sense for me to hire somebody to be the morning baker, because I just don't know how to do that, because it's more complicated than it seems every time. It's like, it's not just $15 an hour. It's all sorts of things I can't think of. You know what I mean? Or is it? I'm not sure. So I guess at some point I'd love to kind of get into that more. Or if you have any resources that maybe you can point me to read on that and to learn about it, that'd be great too.
Sure. Yeah, that'd be great.
We can
Thank
definitely.
you. Sorry, I didn't mean to steer off there, but
It's
Nope.
good.
It's great. That's what we wanted to talk about today. So we can definitely talk about that. We have resources on it. We can talk about it in one-on-one time too.
Mhm.
But we will send over the personal income sheets. And next week, we are going to be going over maintenance, quarterly maintenance. And last week will be the end of our
Yeah.
workshop. So until the next one.
Awesome.
All right. All
All right.
right.
Well, thank you so much. I appreciate it.
Have a good
See ya.
day. Thanks, Sam.
Bye.
All right. Bye-bye.